chart. All right, so I'm going to go back to the 5 minute because I can't locate the exact spot here. But essentially, what we do with a sniper trade is we pick a point on a higher time frame that we would like to enter a trade on, and once we find that spot on the higher time frame, we then move down to a lower time frame to give ourselves the best possible entry and use the fewest amount of pips possible for our risk. The only part of a trade that you have complete control over is your risk. That's the only part. Everything else is pretty much up to the market. And we called this trade. It had a 75 pip potential take profit. And we entered on a 5 minute chart. Now, this 75 pips came from the 1 hour chart. We did a price projection on the 1 hour chart and believed that 75 pips would be our take profit. We entered the trade on a 5 minute chart, as you can see, and we only used the 10 pip stop. And it took most of the day, but our stop, which was actually up here, our stop was never hit. Okay? And we eventually hit our 75 pip take profit. All right, so that's the general idea. We were looking for a setup on a higher time frame, and then we're looking to trade it on a lower time frame using a much smaller risk. All right, so what I'm going to do is a very quick review of how we looked at those sniper trades and how we picked them out, that sort of thing. So as I usually do, I'll ask you guys to give me a pair and a time frame, and we'll pick it up from there. All right. So if let me see, Harry, can you give me a pair that you want to look at? And I'm waiting for Harry to type. EN. Is that Euro New Zealand, Harry? Okay, Euro New Zealand. Let me just see where that is. Euro New Zealand. Okay. And Daryl, give me a time frame, please. Okay, 30 minute. We're going to go to a 30-minute chart. And someone just opened up their microphone. The television in the background. Oh, that's Gene. I hear the bird, Gene.
Good morning.
Good morning.
Yeah,
Gene.
good morning. What time did you guys start this morning?
8:30. Could you mute your microphone, Gene?
Mute it? Sure.
Yep. And
Yeah.
then I'll call on you during the day.
Of course.
All right. So we're going to look at this Euro New Zealand 30-minute chart, and then Joe's guy wants to look at the dollar CAD, and Phil, Phil won, Joe's guy. Oh, Helen says she can hardly hear me. How's my audio with everybody else? Just give me a yes if it's clear. Okay, Helen, I'm not exactly sure what's going on your side. As you can see, everybody else seems to be able to hear it pretty well. And I'm not sure what I can do on my side to help that. Okay. But see what you can do with the settings on your side. Okay, so Joe is telling me that he has a new person in the room, Raul. Okay, hello, Raul. How are you? And I will try to give you a preference, okay? And Joe, when you log in next time, if you were to log in as Joe K, I'll know who you are. All right, because we may end up with a couple of Joes in the room, because I do know a couple other guys named Joe that I invited. All right. Um, what we looked at last week, we were looking basically at price action. And I'm going to do this very quickly. And I will have a more formal presentation of price action that I'm going to do privately when it's quiet. And I will record it and I will post it where you guys can go download it and watch it. All right? So if you've missed anything, don't worry about it. Later in the day, I will post the link for the other two recordings. I'm sorry, the other two lessons that were recorded, so you could, get up to speed. Okay? So essentially, what we were looking at was price action, and the definition of price action that I use is price action is the natural movement of the market made up of consistent, repeatable patterns. Again, the natural movement of the market made up of consistent, repeatable patterns. That's what I call price action. And the patterns that are consistent and repeatable are the uptrend, the downtrend, the sideways or consolidating market, like this, or like this, that's sideways or consolidating, or the instant reversal where just one candle changes the entire direction of the market. And this situation here, this would be an instant reversal. The entire market changed direction right after this candle. So that's an instant reversal. Okay? So we have the uptrend, the downtrend, sideways market, instant reversal. Those are the four pieces of the price action that I look at. And consider them building blocks. Price is always in one of these four modes. Our job is to find out which mode we're in and then, figure out or develop a system to trade that particular mode. All right? They're the same four building blocks. It doesn't matter what time frame, doesn't matter what pair. What we are challenged to do is to try to recognize them. All right? So they may not all land perfectly one right after another. You may get, two consolidations in a row like we have here. Here's a consolidation. And it moved up one candle and went right back into consolidation again, then gave us a bit of an uptrend, then gave us a downtrend, and then gave us an instant reversal. Right after this candle, the market took off and never looked back. Okay? What we then did was we broke down the four components, or we broke down the components of an uptrend and a downtrend and broke them down into their basic core DNA parts, as I like to call them. So in order to make a downtrend, you have to have candles that close lower than they opened. So you have to have down candles, negative candles, short candles. There are many, many words for them, but that's what you need. All trends take a move in the direction of the trend, and then they pull back. So in this downtrend here, you see we have a move down. All right, and I'll put this on this side so we can see it. I'll get rid of this. We have a push down, and then we have our pullback right here. And then the market pushes down again, and then it pulls back again. And then the market pushes down again, and now we're in a consolidation right here. Okay, so in a downtrend, you have a thrust in the direction of the trend, and then a pullback the opposite way, and then another thrust in the direction of the trend, and then another pullback. All right? So if I had to build a downtrend, I know I need short candles, and I know I need pullback candles. Okay? Now, what pullback candles are, in my definition, with pullback candles, what we're looking for the very lowest point of each candle. And let me open this up and go back here. You see this low is followed by another short candle, and the low of that short candle is lower than the prior candle's low. So you know we're still going downhill. Then it makes another short candle, and the low of this short candle is lower than the candle in front of it. What we then look for are pullback candles. What a pullback candle is a candle whose low does not go lower than the prior candle's low. The first time that happens, that's a clue that the market may be ready to pull back. Because when the market is in its drive direction, when the market is moving in the direction of the trend, all of the lows get all the lows get consecutively lower. I got it. Okay? So here's a situation where we have a low that did not trade below this low. This is a higher low on this particular candle. As soon as we see that, our clue or our next idea would be to put a trend line across that, because we can assume now that the market may pull back for a bit. And then one way we can take advantage of this, because it's a repeatable, consistent pattern, okay, pullbacks are repeatable. All right, you see in this uptrend, market moved, the market went up, and then it pulled back. It went up again, and then it pulled back again. So you see that pullbacks are consistent, repeatable patterns. That's what we're looking for. We're not trying to guess which way the market's going. We're not trying to be a super analyst, figuring out all the macroeconomic trends and all that. We're simply looking at what price is doing on the chart, and we're trying our best to take advantage of it. All right? So this candle high was lower than the prior candle's low. This candle's low, rather, was lower than the prior candle's low. Then the market takes off in its direction again, and you see the low of this candle, and then we have another candle that has a lower low. So we know we're still going downhill. Then we have another candle that has a lower low. And then we have another candle that has a lower low. And then all of a sudden, we get another candle, but this time the low could not reach the prior candle's low. That's a clue that we could be in a pullback. Our job then is to put a trend line across it and just observe it. Okay? And ideally what we want to do is we want to re-enter the trade back in the direction of the overall trend, and we want to do it on a break of that trend line if possible. That's the general premise of a sniper trade, or one type of sniper trade. There are several, but if you want to trade a trend, this is one way of doing it. Okay? Now, in most traditional trading systems, they'll say if you enter this trend line break, you would enter at the close of this candle, and they teach you to put your stop at the old swing high or swing low. Okay, but if you see here, that's 102 pip, let's say 100 pip stop. Okay, that's a bit much for me. Okay, 100 pip stop. But that is generally what a great many places will tell you. Again, if you were to enter this trade at the close of this candle, you're taught often to put your stop at the swing high. In this case, it would be a 60 pip stop. Okay? Again, for me personally, that's a bit much. I try not to use stops any larger than 20 pips, no matter what time frame I'm on. All right? Now, how do we accomplish this? Well, what we want to do now is take this point, and we want to go down to a lower time frame and look for an entry on a lower time frame. Our profit target will be based on this 30-minute chart. Okay? So on this 30-minute chart, if we look at our first thrust down, and if you remember from last week, what we did was we measured each thrust, and generally the first thrust, second thrust, and third thrust, or impulse move, or drive move, they'll all be about the same. So here we have this push down, and it's roughly 90 pips. Okay, it says 95, but let's just round it out to 90. So I'm thinking that this next move down should be about 90 pips, and I'm going to assume an entry below this candle. And sure enough, we made our 90 pips. All right, then let's assume this third move down here, and as we can see, this market appears to want to go short at the moment. And this would be our profit target down in here, just a few pips above the bottom of this projected line. So what we do is on the 30-minute chart, we will get our projected take profit. All right. So let's take the last trade here, okay, in this area, because graphically it'll be easier to show you. Once we have this trend line in place, we're looking to break this trend line somewhere. Ideally, you want to enter basically one tick below this low, because this was the last of these lows to touch the trend line. All right? So we're looking for a break of this low. So what we'll do is we will mark this point right here, because that's the, what we're looking for. And then we're going to mark the next candle, because we're looking for something to happen on that next candle that will get us in the trade. Everybody understand how we did that so far? Delete. Let me just clean up some of this stuff so we don't get confused. Does everyone see how we arrived at this point? Now, I know I'm going a bit faster than I did the first 2 days. Okay, just give me a yes or a no if you understand how we reached this point so far. Oh, I see this chat. I have to scroll it down. I'm sorry. I didn't see the responses because the chat didn't scroll down. Okay, great. So now what we're going to do is we're going to take this point right here, which is what I call a sniper point. And I call it that because if you look at this, it's almost like the crosshairs of a rifle or something. All right? And now we're going to go down, let's say, to a 5-minute chart. And then I'm going to look for that point. I have to turn this off. I'm going to go down to a 5-minute chart, and I'm going to look for this point. And what I want to do is take a trade below here. I want to take a trade below this line. This is my point in the sand here. Let me squeeze this in a bit. I want to take a trade right in here, below here. So I need to see a signal below here. The simplest signal is the close below this line. Okay? And the reason I wanted to take a signal below this line is that once I take a signal below this line, in most cases, excuse me, the top candle of the wick has formed already. And I'll touch on that in a second. So now this would be our new entry here. This is our new stop, which is, let's say, 30 pips. So we've cut our stop down by 2/3. But our target is still going to be that 100-pip move based on the 30-minute chart. Does everyone understand that? No, Michael. Michael is asking me if this works on all time frames. It works on all time frames, Michael. Okay. I don't know how, if you know how we do things in the room, but briefly, I ask the participants in the room to pick a time frame and pick any pair, and then I show you on the stuff you pick that it works. I'm not running around hand picking the perfect chart. I don't do that. Okay, I'm not trying to sell you a $98 ebook. I'm trying to, show you how to make some money. Okay? So what we do now is we enter here, and this would be our swing high. Ideally, we have another small swing high right here. Right there, these two candle tops. So here we can go here, and now we've got something more my liking, about a 20-pip stop. So we've got a 20-pip stop, and based on the 30-minute chart, let me go back to the 30. Based on the 30-minute chart, we're looking at about a 100-pip move short. Okay? And that's how we would pick our profit target. Let me open this up a little more. So everyone understand we measured from here to here, got an idea of this move, all right? And then we're projecting that our entry will give us the same take profit here. So what I want to do here is I'm going to take this line from here to here, okay? And I'm going to drop it right down in here. And that's our projected profit target. And now I'll go back to the 5-minute chart. And let me squeeze this in a bit. Okay. Okay, perfect. Let me squeeze this in a little bit more. Okay, can everyone see that? So you see how we entered the same trade that normally would have had about a 100 pip stop on the 30-minute chart, and we're now in the same trade with a 20 pip stop, but we're still looking at basically our 100 pip take profit, and we got pretty damn close to it. All right, let's just see where our entry would be. And so far, it's already moved about 70 pips. So right off the bat, Ron is asking, could you go to a 1 minute instead of a 5? Yes, you could, Ron, but you may end up needing to take more entries, and I'll explain that in a minute. All right. So you see the premise. You see what we did here. We started at a 30-minute chart. We found our pullback candle. Remember, pullbacks are a natural part of any trend, be it an uptrend or a downtrend. What we tried to do is take advantage of that repeatable, consistent pattern. And this is what we're looking for, repeatable, consistent patterns. Once we found that pattern, we now go down to a 5-minute chart and try to find an entry in the same direction using the profit target from the 30-minute chart, but we want to dramatically decrease our risk. So we've changed this from a 100 pip stop loss to a 20 pip stop loss. Yes, Michael, the pullback candle is specifically defined. I'm assuming this is your first day here. Am I correct, Mike? I'm just waiting for Michael to type. Okay, partially. That's either a yes or a no, Mike. I'm a very nice guy, but when I try to get real specific about things, I can be a bit tough. Okay, so this is your first day here. The pullback candles are specifically defined. All right, and if it's okay with the room, I want to take 3 minutes and just run through it quickly for Michael's sake, and then I want to move on. If that's okay with the room, just give me a yes. Just give me a Y or an N. It won't take very long at all. Okay, Mike, you're in luck. People like you, okay? If you had a box of candles, Michael, and someone said, Mike, I need you to build a downtrend. Well, then there's certain kind of candles you would need. There are certain types of candles you would need in order to build that downtrend. The first thing you would need in order to build a downtrend is you need down candles. And I don't mean candles made out of feathers. I mean candles that close lower than when they opened. Okay, are you familiar? Are you familiar with candlestick basics, Mike? Okay, great. So you know that short candles or down candles or negative candles are candles that close at a lower price than the open. Okay, so that's the first thing you need. You need down candles. So a downtrend moves 3 to 5 candles in your direction, generally. And then when it starts to pull back, the downtrend will pull back generally 2 to 3 candles. All right? So we know we're clear about what a down candle is. So if we had to build a downtrend, you need a down candle. The next thing we need the pullback candles, because markets drop and they pull back. They drop and they pull back. They drop and they pull back. Do you understand that part, Michael? Okay, great. All right, so the next thing we need are pullback candles. So how do we define a pullback candle clearly so everyone can get on board with it? With the pullback candles, now we didn't go into candlestick DNA yet, Mike, so don't worry about it. Once I get into the construction of candles and what to look for, it'll make certain things easier to understand. But what we're looking for in pullback candles are, if we're in a downtrend, we're looking for that first candle that cannot make a lower low than the prior candle. Are you with me on that, Mike? That's a clearly defined definition of a pullback candle. Very simple, not complicated, no fancy words, no bells and whistles. Clearly defined. We're looking for that first candle. In this case, it would be this candle. in the middle of the screen, the low of this candle is higher than this low. As soon as we see that, that's our clue that we're about to enter a downtrend. We're about to enter a pullback in a downtrend. Okay? You'll notice here that this candle is the opposite color of the down candle. But you'll notice here that this candle is the opposite color of the down candle too, but look at the low. This low was still lower than this, giving you an indication that the market is still heading downhill. All right? So once we have that first candle that cannot breach the low of the prior candle, we put a trend line on it. That's our pullback candle. And you need two. You need the original candle, and then you need the first one that can't break that low. All right? And if you look over here, we had the same thing here. You see this? This candle cannot breach this low, Michael. We put a trend line on it. Okay, Matt's asking me to be specific, and I'm trying to understand what he means. Matt, what is it that you're asking me to be specific about? Do you connect the lows or the lows of the closed candles? Everything I do is based on a closed candle. Everything I do is based on a closed candle. And when you're looking at pullbacks, you're connecting the lows of the candle, not the closes. You're connecting the lows. And that's very important to understand. The candle wick has a specific function, and it has specific information. He said, but the first one is not specific. The first one is not specific. I don't understand what you mean, Matt. The first one is not specific. The first trend line. Are you speaking about this trend line, Matt? You're saying this one is not specific? Why is it not specific? When the rule is you're looking for a candlestick where the low could not go lower than the low of the prior candle. That's what we're looking for. We want the first situation where the low of the new candle cannot go lower than the low of the prior candle in a downtrend. Do you understand that, Matt? All right, so here's the trend line. I'm going to draw that. Let me just erase this. I'm going to get a new trend line. When I see this low and it cannot breach that low, I start at the original candle and I connect the lows of the candles like that. Okay? Now is GNU. It was fine before, Matt. I think you may have kind of misunderstood something. Because I make it very, very specific, very, very clear. A 2-year-old could figure this out. If I tell them which one of these little sticks on the bottom is higher or lower than the stick in front of it, I try to keep it that simple. Not that people in the room are simple, but the easier you make trading, the more fun you can have trading. And I'm not looking to overcomplicate. So here's that same situation here, Michael. Yeah, I know I have to introduce you to a really, really good friend of mine, Michael Schumann. I think you guys will get along really well. Okay. Oh yeah, I know. I realize that, Phil. I don't know how much experience Matt has. An experienced trader would understand that. So yeah, he may think I drew it through the body, but it's always to the lows. It just happens that the width of this body sticks out a little bit. Okay. Now, Matt, you see how I drew this trend line and I didn't quite hit the bottoms? Sometimes if I'm drawing the trend lines quickly, I might not hit it dead on. Okay? All right, so this is what we're looking at. So this would be our trend line. Okay? Here would be another one here. You see that? We're in a downtrend. And this low could not get lower than this low. The low of this candle is higher than the low of this candle. And then here I would put a trend line. You follow me? Now, I would do all of this on a higher time frame, by the way. I mean, if I did it on a 5 minute, then you'd have to really go down to a 1 minute to look for the entry. Okay, so that's what a pullback candle is. A candle that in a downtrend, a candle whose low is higher than the previous candle's low. All right, good. So now that we've solved that, let's go back to the 30. And let me drop the trend line again. And did you understand how we came up with the entry, Mike? Okay, so now we drew this trend line, and we see this candle went up, and we got the pin bar here, which is another big clue, but we'll talk about pin bars, in a week or so. And right here, we want to get a break back in the direction of the trend. We've estimated our profit target by measuring the last push down in the market on the 30-minute chart on the higher time frame. And then we reference that down here. We just copy the line down here to about where our entry would be. And what we want to do is we want to get into this, and instead of using a 50 pip stop or a 100 pip stop, we want to get into this trade using a much smaller stop on a smaller time frame. All right? And then what we do is we mark the next candle, okay, after this one, because it's going to all happen here. And then we mark the bottom of that wick, and that gives us a crosshair. Okay? And now we go down to our 5-minute chart, and we look for that crosshair. And that would be right here. Okay, so you see that's the crosshair. And we're looking to enter below this low. I'm sorry, we're looking to enter below this line, and this line represents that bottom wick that we saw. How do you know if before being print? Pavel, I'm not quite sure what you're trying to ask me. Okay, if you could, retype that question, I'm not sure what it is. All right, and we want to take an entry below here. Okay. The simplest entry is a close below this line, and then you can enter at the open of the next candle. And you want to put your stop loss out at your nearest swing high. I prefer not to go more than 20 pips, and this nice swing high here looks good to me. So there would be my 20 pip stop. And now my profit target is going to be just a few ticks above the bottom of this line here. So I'm looking at about an 80 pip or 75 pip take profit. And as you can see, this trade unfolded already in that direction. Okay? So he's saying the whole candle must be below 5-minute? No, 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 no. There are many ways to enter this. I'm showing you a very simple way of doing it. Tony, would you have been stopped out on the third entry, back on the 30-minute, when you're done here? Would you have been stopped out on the third entry? I don't know what you mean by the third entry here. Let me go back to this. I want to make sure before we move on. Where is the third entry? Yeah, Phil kind of has it right. It's a trading method and not specifically a system, because if you have a way of getting into trades that you really, really like, keep doing that. All I'm saying is I'm showing you a much, much better way of getting into that same trade in the direction of the trend with a clear-cut profit target and using a smaller stop. Two candles to the right of your red line. Well, there are a couple. Okay, let's assume it's this red line, Tony. Yes. I'm trying to understand what it is he's asking me. Yes, Tony, turn your microphone on.
Can you hear me?
Yes, I can, Tony.
Okay, so you've got Where you've got that red line, two candles to the right of that
Wait,
is
which red line? Which red line? The horizontal or the vertical red line?
the vertical one.
This one?
Yep. So two candles to the right of that.
1, 2. Yes.
No, that's to the left.
Pin bar? Oh, to the right.
No, you're going to the left and to the right. So that low, the low of that one, the next candle, the low is higher. So it looks like you could draw a trend line in there and do another entry, a whole complete other entry. Would you have
Oh, right
taken
in
that?
here. Right here?
Yes, exactly. Yep.
Yes, you could have. Okay, but we're talking about this trade. There are many, many other trades in here.
Sure.
But yeah, this trade you could have taken, yes.
Yeah, and would it have
let me
been a
draw the
winner,
trend
or can
line
we go
here.
and look at that one after you finish with this one?
I'm sorry, could you repeat that?
Sorry. Once you finished looking at the trade we're looking at now, can we have a look at that one? Because to
Yes,
me, it
we'll
looks
come
like
back
we
and look
would
at
have.
that one also. Okay, great.
Cool, thanks, man.
But I want to make sure everybody understands the premise of this trade first. Okay? Does everybody understand the premise of this first trade that we're looking at, this pullback? Okay, so you understand what a pullback candle is. A candle, if you're in a downtrend, you want a candle that doesn't break the low of the prior candle. And we know that in a downtrend, you need down candles. Okay? We also know that in a downtrend, the price moves down X number of pips, then pulls back. The moves down, the thrust moves, the impulse moves are generally about the same size. There's 2 and there's 3. Okay? Now you get 3 to 5 candles in your direction generally, 1, 2, 3, and then a pullback. 1, 2, 3, 4, 5, and then a pullback. 1, 2, 3, and then a pullback. You get 3 to 5 candles in the direction of the trend, and then 2 to 3 backwards. Okay? Now, as I mentioned last week, I look at 3 pushes down. After the third push down, I'm less likely to continue to go short because in many cases, the market will either consolidate or reverse. Okay? So in this particular case, I would not have taken this trade because I already had 3, 1, 2. I already had 3 pushes down. I wouldn't go any more short here. Now that's me personally. But now let's take these rules and apply it to this trade. All right, so we can take a look at it. This is our trend line. Okay. Now, Matt, I'm connecting the bottoms, and I know you may think I'm connecting the edge of the candle, but I'm not. I'm connecting the bottoms. It's just the way the candles form. Did you understand that, Matt? Okay. So now this is our trade. And what we're looking for now is, because this is the last touch right here, unless price moves up and comes back and touches it again, we're looking for a short below this low. So I'm going to mark this low, and then I'm going to mark the next candle. All right, and that's my crosshair. And what I'm looking for is to get into a trade below this crosshair. All right, and I want the entire trade setup to happen below the crosshair. So let's go to the 5-minute chart. Am I following this through, Tony, the way you want? And here's our crosshair right here. Okay, so this could be a potential entry here. And I like this for my stop. That's a 20-pip stop. And again, if we measured out the other move, we're looking at a 75, 80-pip move in our direction. Now, in this case, we certainly would have had a stop out. And that would not have bothered me, simply because the risk-reward is so great. I can afford 2 or 3 of those and still get into the trade with a small stop and still walk away profitable. So if I'm looking at a 20 pip stop and a 75 pip take profit, I can take 3 of those losses if necessary and still come out ahead. Okay? And no system or method is going to be 100%. So don't look for the Holy Grail. Believe me, be willing to put some back into the market. But as I mentioned, on that 30-minute chart or a 1-hour chart or a daily chart, after 3 moves down, I'm not looking to go down anymore. All right? And that's my own personal rule. And it keeps me out of a lot of trades. And again, this goes back to the price action DNA. When you turn a chart on, I'll give you an example. If we turn the chart on, and let's say we were right here. Okay? See this? I'm saying, okay, we're in an uptrend. I've got a nice push down, a pullback, my second push down. What I'm looking for right now is a pullback. Okay? And then after that pullback, I would look for the third push down, and I would look for it to be pretty much equal to these two. Do you follow that, Tony? It's understanding where am I in, which one of the building blocks am I in price action. Right now I'm in a downtrend. Most uptrends and downtrends give you 3 moves that are relatively equal. Yes, Tony, the entries are everywhere, but we're just not taught to look at them. We're taught to look at a whole bunch of indicators and other nonsense. And I'm not saying indicators are nonsense, because once we get into the indicator part of things, you'll really see how if you match the right indicator with the right price action pattern, it really bumps your accuracy rate up high. That's okay, Tony. But you understand, once I know where I am, I know I'm in the second of 3 pushes down, so now I'm just waiting for the pullback. So I'm going to hit F12. Okay, aha, I have a potential pullback here because now this candle is higher, this wick is higher than that one. So I would put my trend line here. Obviously I can't stretch it out, but you get the idea. I'll go F12 again, move over one more candle, and lo and behold, look how that held. Isn't that interesting? I'll go F12 again, and now I can adjust my trend line a little bit. Oh, wrong tool. All right. But you see how it works. Is everybody sort of clear on that? When you turn a chart on, you want to know where am I in those building blocks? Which of those 4 building blocks am I in? And then when you know which of the 4 building blocks you're in, your next question is, how do I trade that building block? Or do I trade that building block? Is that part of my package, part of my trading plan? Okay? Just to keep things clear, let's pick one more pair and one more time frame. And I believe Phil's guy wanted dollar CAD. I'm trying to roll back up in the chart. I'm sorry, Joe, Phil Joe, or Joey Phillips, I'll call him. I believe Joe's guy wanted it was a dollar CAD. Was it dollar CAD 15-minute, Phil? Well, let's go to dollar CAD first, because I believe it was a dollar CAD. Well, no, I'm trying to get Phil's attention. I'm not sure if he's in the room. Okay, he's not here. So you know what? I'm going to go with the 15-minute from Michael and the pound yen from Teddy. Is everybody good with that? I'm going to go 15-minute chart from Michael and the pound yen from Teddy. And let's go to current time frame. Now, out of the 4 building blocks, which one are we in right now? Are we in an uptrend, a downtrend, a sideways market, or a consolidating market, or are we at an instant reversal? Okay, I got some people saying up. I've got some people saying down. Rich is saying sideways. Gene is saying down. Okay. We are in a sideways market. And we're going to talk about consolidations in a few minutes. We're in a sideways market. And why do I say that? If I take a look back at the last 7, 8 candles, that gives me an idea where we are. What you'll notice is that none of these last few candles could close above this candle high, and none of the last few candles could close below this candle low. You see that? All of these candles, all of these 15-minute candles have been caught in this trap, and they can't get out. You see that? So right now we are in a consolidating market in a potential downtrend. Okay, where are you in the whole price action scheme? Now, we did not talk about consolidating markets yet. But this is what I want you to look at every time you turn on a chart. Where am I in the grand scheme of things? And if you remember Tony and Phil 916, I think it is. Remember I said I don't like to go back in the trend after 3 pushes? Look, that's push number 1. And the length of push number 1 is pretty much the length of push number 2. And it's pretty much the length of push number 3. After the 3rd one, I wouldn't be likely to take another long. You see that, guys? This is what I talked about on that other chart. After 3 pushes in one direction, now this is me personally. Sometimes it goes 4 or 5. That's cool. All right? I can't get every pit. You know, I'm looking for high probability, minimal risk. And after I see 3 pushes up, I'm not interested in chasing it anymore. You follow me? I'll wait until it turns around and then gives me some decent signals, and then I'll jump on the counter trend. But I'm not going to chase it after 3 pushes up. And again, if we look at this uptrend here, all right, and you guys pick the time frame and you guys pick the pair, okay, Matt, you're trying to ask for control of the screen, and this thing gets buggy when it does that, and I don't want to bump the whole room out. So I'm going to decline that for now. Okay? And I know you probably want to point something out. But the last time we tried this, everybody got bumped out of the room. So I'm not going to risk that anymore. And I've tried privately to work it out to give someone control so they could point at stuff on the chart, and it still didn't work out correctly. Now, Phil is saying the second push is the highest probability, like EW3. Yeah. Now, I don't want to talk about Elliott wave theory at the moment, okay? Because I don't want to confuse any of the newer people. I want to keep it pretty simple and stick with just really basics of price action and DNA, price action DNA. Now, the reason I also mentioned earlier is that I do everything off the closing price. I'll get to your question in a minute, Pip Thief. Is that you notice when we came here, as I was talking about price not being able to close below this low, if you remember, this current candle was a white candle all the way down here. You guys remember that? Okay, this candle was a white candle all the way below here, and look at where it's heading. It's falling right back into the trap. Okay, so this is a consolidating market. Okay, it's bouncing back and forward inside this trap. My bias, yeah, Phil, 3 up and 2 down. It's simple, but I don't want to get the Elliott wave thing in it, because then other people are going to ask a bunch of Elliott wave questions, and then they're going to want to know just about the other built-in things with Elliott waves. And we will cover Elliott waves when we go into other theories. When we get into Fibonacci, Elliott waves, Andrews pitchfork, and Gann. When we cover those, then you'll understand why I need to keep it separate from this particular lesson. All right, any questions on this? You see where we're in a consolidating market? And there are 2 types of consolidations going on here at the same time. I'm going to show you both of them. The first type of consolidation that we have is this price trap. And this is where none of the next few candles could close above this high or this low. There's something about this price and this price that has everything bottled up. Does everyone see that clearly? Just give me a Y or an N. Yes or no? All right? That's the first type of consolidation. Tony is asking me to repeat it. All of these candles, all of these 15-minute pound yen candles, 1, 2, 3, 4, 5, the last hour and a half, counting this candle, nothing has been able to close above this high, nothing has been able to close below that low. This candle is what I call a price trap. And these price traps, they're a form of one of several forms of consolidation, but they are all over the chart. And when you learn how to trade them, they can be very, very lucrative for you. All right? Now, I'm going to show you. Here we have a candle, and the price trap is defined as a candle where the next two candles, after the original candle, the next two cannot close above the high or low of the original candle. Yeah, I know Joe Ross has a different name for it. And I think he also implies it in his Ross hook. And I'm not exactly sure what he calls it. Other people call this a master candle, where they call this the master candle, and all these candles are kind of locked into what the so-called master candle says they're allowed to do. All right? So I want you to see, here we have a candle, and the next two candles could not close above this high or below that low. And I always go with two candles. I always go with two candles. Because more often than not, when the market is in a strong trend, it will take a one candle break. And sometimes that one candle will be inside the prior candle. And then the next candle could shoot off to the moon. A measuring bar might be another name for it too, yes. But I call it a master candle. Now I'm going to point out a couple of them. Here's our target candle, and then you'll see that the next two candles couldn't get above the high or low. Here's our target candle, this guy right here. And notice the next two couldn't get above the high or low. I'm going to mark that one also. Okay? Here is our target candle, and the next two couldn't break the high or low. See that? These next two, even though this traded way down here, when it closed higher than this candle's low. All right? Here's our trap candle right here. And the next two candles could not close above this high or close below that low. These are also all over the chart. You see that? The wick of this candle went sky high, but it did not close below this high. So these two candles, and as soon as I have two candles, that's the trap. Okay, here's another one here. You see these two candles could not close below this low or above that high? I can mark that right there. Let me roll back. I want to show you enough of them so you know that this is why I call this one of the building blocks. And I'll tell you why the close is so important. The closing price is where all of the participants have decided that that's where they're going to stop the price on that particular candle. The closing price means that the candle has come to an end and all of the historical data is there for us to see. And nobody knows while a candle is forming what kind of candle it's going to be, how large a candle it's going to be, how wide the body is going to be, or how long the wicks are going to be. Nobody can predict that. Nobody. But as soon as the candle closes, now we can say, aha, and we can look at the information. Each candle, when we get into individual candle DNA, I'll get into that a bit more. But each candle, it would help for you to look at it as a chapter in a book. And each candle adds another chapter to the mystery you're reading. You follow what I'm saying? And each candle offers clues as to what may be coming in the future. That's why I prefer the closing price. Because if we go back to this original price trap here, let me get rid of this one. Delete. If you remember when I drew this originally, this candle came all the way down here and was a white solid candle. You remember that? And it looked like this was going to break short. And a lot of people would have jumped on this short before the candle closed. And look where it ended up. It ended up at the close of the candle right back in the trap. That's why the closing prices are so important. Okay? If you are a trader who has a natural built-in gunslinger attitude, well then yeah, go ahead. If you want to enter a trade before the candle is closed, be my friend. Go ahead and do it. I am not that type of person. I prefer to let the market give me the information that's there and then make a decision. So I'm not saying that you're wrong for entering a trade before the close of a candle. I'm just saying it may be more impulsive in nature. Okay, Phil is typing. Yeah, it's also easier to backtest, Phil. Yeah, absolutely correct. Phil 919 is saying that it's easier to backtest on closed candles, and it absolutely is. All right, so I was showing you these price traps. All right, here is another one right here. You see the next two candles after this white candle could not close above the high or low. As soon as I get two candles, that's when I draw my trap. Two candles. Okay, now it could go 20 candles. And if it goes 20, that's even more in my favor. You follow me? In this particular case, my bias on the trade would be long. In this particular case, my bias on the trade would be short. And I'll get to that in a moment. But I want you to see the price traps. You see this candle right here? Notice the next two could not close above the high or below the low. That is a price trap. Okay, now I don't trade every price trap, but I'm always trying to be aware of where they are. Now look at this candle. You see this candle where the next candle did not close above the high or low, but we never got a second candle to do the same. So this would not be a price trap. You follow me? Because I don't have the two candles inside this one. You have to have the two. Same thing here. This candle could not close below this low. This candle could not close above this high. That was the first one. Okay, cool. The second candle showed up, but then the second candle closed below the low of the first trap candle. So this is not a trap. This is why I say I need two candles. When the market is really moving, sometimes it will take a one candle break. Okay? Let me go look for another one. Here's one, this white candle, right here. And notice that the next two candles could not close. And again, close, 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 close above the high or low of that trap candle. All right? Any questions on that? You need a candle followed by two candles that cannot close above the high or low of the prior candle. That's the first type of consolidation. Okay, it's a range-bound consolidation. And now when we go back into, remember when I said if you had a box of candles and you had to build a downtrend? Okay, now Pip Thief, Lou, do you also try to enter after the first pullback? Pip Thief is asking me if I'm trying to enter after the first pullback. First pullback of what, Pip Thief? We haven't talked about how to trade these traps yet. We haven't talked about trading them yet. Normally you talk about three pushes. We're talking about price traps, Pip Thief. I'm not sure what you're getting at. Are you going back to the 3 pushes of the uptrend or downtrend? Because we're talking about a different topic. Okay, if you're asking me about the 3 pushes in the uptrend and downtrend, this is my personal way of looking at it. Okay? And I'm not saying it's 100% right for everybody. But if I get 3 solid pushes, I'm not going to take a 4th one in that direction unless there's overwhelming evidence that there's enough energy in the market to take another shot in that direction. But 3 is enough. And part of the reason for me that 3 is enough is that you've got about 20 pairs you can pick from. Some traders do not use the first pullback after the trend shift. That's a personal choice, but when I show you how to analyze trend change and how to know when you're moving in a new direction, you'll be more likely to take those. Yeah, some traders do not use the first pullback after the trend shift, and that's up to them. But once you learn how do I spot the trend change, and how do I know I have a confirmed trend change, then you may be more likely to take advantage of that first move, or at least scalp some of it. Okay? So I'm glad that this happened in a live market that you guys picked, because like I said, I don't like to go and cherry pick the perfect chart. That's not the world we live in. Okay? So, do we understand the definition of a price trap? A price trap is a candle that is followed by 2 candles that cannot close above the original candle's high or low. Oh, and by the way, I'm working on PDFs for all this stuff too. But I have to use the Premier Pioneer Trade letterhead and all that. So I'm working on that in the background. So there's other stuff going on. And I'll have a website where I can share stuff with you guys. Okay? So, don't worry about that. You'll get all this stuff in writing. All right? So, again, a price trap is a candle followed by 2 candles that cannot close above the first candle's high or low. All right? Is there any question about that? Because I try to keep these definitions simple, and I try to do them so literally like a first grader or a second grader can figure it out. Because trading is not complicated. We make it complicated. And it's just the human mind, for some reason, just needs to kind of kafumpter stuff, as I call it. This is one type of consolidation called range-bound consolidation. All right? Now, the next type of consolidation are pennants and wedges. And what consolidation is? Consolidation are those areas in the market where the market has indecision, or the market comes to a consensus as to value and price. Now, what I mean by consensus, at this point in the market, when the market started driving up, all the buyers and sellers in the world felt that this market had more value. It was worth buying here. Did you follow me? That's why this thing went up, because the buyers came in and said, yeah, we wanted it at these prices. Then the sellers came in and pushed it down a little bit, and now we're at a point where the buyers and sellers pretty much agree on the value of the pound yen at the moment. Did you see that? And they've agreed on this general range of price for the last hour and a half. So consolidations are those areas in markets, excuse me, where you have some those areas in the markets where you do have some indecision, but also the masses of the buyers and sellers also agree that at the moment that this particular stock or equity or whatever instrument you're looking at the moment they feel this price is relatively fair, give or take a little bit. Okay? That's one type of consolidation range bound in a price trap.